Hi traders, and welcome to today's video on the top 3 chart pattern strategies. In today's presentation, we'll be looking at the top 3 chart patterns used by traders around the world. We're going to be looking at double top and double bottom patterns. We'll take a look at head and shoulders patterns and inverse head and shoulders patterns, and we'll cover ascending and descending triangles. Let's first start out with the double top pattern. This pattern forms when we see a series of higher highs and higher lows in price action, and then we come to an area where a peak is formed that's equal to the previous peak. We can then label them peak 1 and peak 2. Once these are formed, we can put a neckline across the bottom trough which joins the two peaks together, and when price does break through that neckline, this formation is complete. On a real chart, it can look something similar to this, where we have a series of higher highs and higher lows, and then we can label our peak 1 and peak 2. The neckline is then drawn, and then we can see the break candle, which is the one highlighted in the blue rectangle. Now, the opposite of a double top is a double bottom, and is formed in much the same way, where we see a series of lower highs and lower lows, and then we come into an area where there's a trough that is equal to the previous trough and no lower, showing a weakness in that downtrend. Once we have these two troughs in place, we can then draw a neckline at the peak that separates these two troughs. And when price does break through, that is our formation complete. A double bottom in the real market looks something like this. We can see that we've got a series of lower highs and lower lows. Once we've got that downtrend established, we can label the two troughs, T1 and T2, and draw the neckline that intersects the peak between those two troughs. Once we get the breakout candle, this formation is complete and ready to trade. The next set of chart patterns that we're going to look at today are the head and shoulders patterns. These patterns are formed in a similar way, where we have a trend going up with a series of higher highs and higher lows. Then we get to an area where we've got a peak that forms, comes down to a trough, and then goes and makes a lower peak. As you can see here, we have what looks like a head and shoulders pattern, where the right shoulder and the left shoulder are lower than the head, which separates the two. Once we see this formation, we can label them left shoulder, head, and right shoulder. Then we can label the neckline, which joins the troughs that separates the peaks that form the head and shoulders, and once price action breaks through, we can trade this pattern. In the real market, it looks something like this. We can see that we've got the uptrend in place with a series of higher highs and higher lows prior to the pattern. We can then go ahead and label the head, the left shoulder, and the right shoulder. Then we draw the neckline, and once we have that candle that breaks through, this formation is complete and ready to trade. Now, the opposite of a head and shoulders pattern is an inverse head and shoulders pattern, and it forms in much the same way, only in reverse. We can see here that we're looking for a series of lower highs and lower lows. And once we have this formation, we can see that we've got a right shoulder, a head, and a left shoulder after what was a downtrend. We can then label these left shoulder, a head, and a right shoulder, and we can draw a neckline that intersects the peaks between these troughs. Once price action moves through that neckline, this pattern is ready to trade. In a real market, it looks something like this. We can see that we've got a downtrend in place with a series of lower highs and lower lows. We can then mark out the head and the two shoulders on the left and on the right, and then we can draw the neckline. Once we get a confirmed close outside the neckline, this trade is ready to place. The next of the patterns that we're going to look at are ascending triangles. Ascending triangles form when we see a series of higher troughs and equal peaks in the market. We can see here that the troughs are getting higher, but the peaks are equal with that top base. Once price breaks through that base, you can see that we've got the breakout and a buy position can be placed. In the real market, it looks something like this. We see the troughs making higher highs as we go, and then the peaks actually form a level where we can draw a parallel line and we see the break candle. Once that candle closes outside the triangle, we can place a trade to trade this pattern. Now, the opposite of an ascending triangle is a descending triangle, and it's formed in much the same way, where we see a series of lower peaks and equal troughs, which forms a triangle. When price does break through the bottom of the triangle, we can place a sell order to trade this pattern. Now, in the real market, it looks something similar to this, where we have a series of lower peaks and equal troughs, and we can draw a triangle that isolates these trade. Once we get a confirmed break of the bottom of the triangle, this pattern is complete and it gives us the opportunity to trade this pattern.